Hey, good morning, everybody. It's Hammer. Today is Friday, November 1st, 2024. I, of course, am with Originator Success here with your daily mortgage rate update, the only place on the web where you get to join me live each and every day, 9:30 a.m. Eastern Time, broadcasting to you on Facebook and on YouTube this morning from the Great Smoky Mountains here in Western North Carolina. If you're watching the replay, don't forget to give me a hashtag replay. If you're here live, say good morning. Don't forget to smash that like button, tag an LO friend, share us in a group. If you're on YouTube, subscribe, thumbs up, tag your LO friends, all that good stuff. Let's go ahead and say hi to the live folks. Who do we got here this morning? If you're here this morning, say hello. There's a whopping 3 people on this morning. I'm guessing that it hit a little late. So we'll go through the other stuff while all the live people get on. Remember, you can sign up for our email lock advice, www.ratelockedvice.com. You can sign up for our text alerts at ratetextalerts.com. You can sign up for a text reminder that I'm going live at hmmr.io/reminder. And last but not least, check us out here at originatorssuccess.com. There you go. Find out how we help you get loans from Google and social media. So here come all my friends. Good morning, y'all. If you're here this morning, say good morning. Let's say hi to all the live folks here this morning. James Mahan, good morning, sir. Sean Segaloff, great to see you. You said, I assume today is candy on sale day. Yeah, that's going to consumer sugar confidence. Amy Blauser, good morning. Mallory Fotiadis, good morning. Great to see you as well. Sean, you had asked a question the other day that I can hit an answer to you for, but I don't remember it. Let me go back and look at the messages and see. You were asking me something to go over. I'm waiting for Facebook to catch up. I have the super high-speed internet, and yet still, I think I need to buy a new computer. Very weak jobs number right before the election. Yep. Explain to you the coupon spreads, why sometimes they are different. That's a great question. So let's go over that real quick, and then we'll get into the jobs data while everyone is hopping on. Good morning, Bill Stevens, Megan Lindbergh, Russell McDonald, Cash Knees. Good morning, sir. All right, so I'm going to pull up the screen with all the fancy stuff. What you'll notice when we look at these coupons, by the way, like we're following the Universal Mortgage Backed Security 5.5 coupon, right? You've got the 6, the 5.0. They go all the way down, I think, to 2.0 right now, and all the way up to, I don't even know how maybe 8 or 9, but they're probably not being traded. So what happens and why there's a different spread? Like the 5.0 has 16 basis points. The 5.5 is 17 basis points. The 6.0, 14 basis points. The reason that you'll see these different is because it's what they're selling for. And the reason that like right now, the 6.0 coupon, if you wanted to buy $100, or actually here, I'll use hundreds, even though I'm showing you $1 million bill. If you wanted to buy $100 worth of bonds, right? So you're buying $100, you would have to pay a premium. You'd have to pay $100.77. So Sean, I will sell you this $100 worth of mortgage-backed security. However, when I sell it to you, you're going to have to pay me $100.78 right now. Why? Why are you paying a premium for this? Well, because the yield on this bond is 6%. So if you would put your money in a checking account right now, you'd get 0. If you put it in a savings account, let's call it 4.25, right? Well, I'm going to give you 6% on your money. So your $100 bond is going to give you a 6% annual return. But in order to get that return, you're going to have to pay me a premium for this, because 6% is a much higher interest rate than what you're going to get on the open market if you put your money somewhere else. Now, if you want something at more of a discount, well, I'll sell you a 5.5 coupon and I'll give you a $100 bond, but you only have to spend $99.20. Why? Because the yield is only 5.5%. So you're getting a lower return on your investment, but it's 5.5 for the life of that bond. Now, remember though, a 5.5 coupon may not always deliver you 5.5. Well, why is that? Well, because of prepayment. When you have either foreclosures or refinances, there is less bonds. There's less in that bond. You're not getting the full return on investment. Now, a 5.0 coupon is currently $97.36. So when you see them change, it's because what's the appetite, the trader appetite. So these are all within a very close range, and you're not seeing much of a difference on here. And that's why it really doesn't matter which one you follow. If we look at the shape of the chart, like this is the 5.5, right? When we look at the shape of the chart, look at the shape. Just really take a minute and look at that. And then let's go ahead and go to the 5.0 and look at the shape. It's no different, right? It went all the way up until September and then went all the way down. So because they're still, you're not going to find them that they're going to go in totally different directions. Nobody is going to be like, oh, well, there's we're going to pay a lot more for this other bond, but we're not going to pay for this bond, right? But it depends on what those bonds are giving you as a yield is what the premium is. And that's what you see here. The reason we follow the 5.5 is it's got the most trading volume. And generally, it's the one you're pricing into. So it's why we do that. So hopefully that explains it a little bit for you. Like right now, if you were to look, and I can't look at it on this one, I may be able to using one of the other services. But if we were to look at like the 2.0 or the 2.5, it's going to have such a low value. $100 of that bond, they're going to be selling it for probably $92, $93 because it's giving no return on investment. There's no hedge against inflation right now. And the prepayment on it is, because it's so low, it's actually better than the higher ones, but that's the other thing. Now, the higher yield ones, people refinance out of, so they lose value. So all of these different variables come into play when you're looking at mortgage-backed securities. So, all right, Mike Morano, Angela Walters, Mike Thibault, Dan Crowley, great to see all of you. National Calzone Day, Ron Siegel, I can get behind that one. Oh, let me turn this off because this is not my lock advice for the moment. Sorry about that. Tom Deadmore, great to have you here. All right, y'all, let's go into it. Let's talk about the 500-pound elephant in the room, right? 500 pounds wouldn't be that much. The 800-pound gorilla, the 5,005-ton elephant. All right, so jobs data this morning shocked everybody. They were looking for about 100,000 jobs created. Instead, we see 12,000 new jobs. If you took government jobs out of that number, we would have actually been negative. Look at that. We had less jobs created than existed. So much for the idea in theory that the jobs data was being manipulated or increased ahead of the election. But yet at the same point, what this does is it drives even more of a question of the validity on all this stuff. There's so many different things, and we'll go deep into the numbers for a minute. But the takeaway here, because the numbers don't really matter, the takeaway here, let's talk about mortgage-backed securities. Let's talk about rates. Mortgage-backed securities are up 17 basis points, not 70, 17. Okay, so where does that put us? I mean, if we turn around and put this on a 3-month, that puts us, they're currently selling at 99.21, which yesterday they were, on Tuesday, they were at 99.27. So rates aren't going to improve. That's the bottom line. Rate sheets today will be slightly better. Bonds are happy about the miss, but there's so much going on in this report that doesn't make sense. Like, we had this huge miss in the number of jobs created, but yet the unemployment was still 4.1%. How does that happen? How do you have unemployment at 4.1% if you only had that? And they're blaming a lot on the hurricanes. And I got to tell you, being in Western North Carolina and watching our area get devastated, before I jumped on this call, I was talking to a buddy of mine. He owns 2 restaurants in Asheville. They are just opening up today. All right. This is now, when did we get the hurricane? I mean, we got hit with this hurricane almost a month ago. So he is opening up a month later. He's reopening his restaurants. So yes, they took a beating, but the fact that no jobs are created last month, like, how many businesses are in Florida or Western North Carolina or the hit sections of South Carolina or Georgia that would have been creating new jobs that were like, don't blame it on the hurricane. Not jobs, right? Like, it just doesn't make sense to me. How many jobs were not created because of the hurricane? I don't. Somebody explain that to me. What do you guys think? Right now, Mike, you've already, yeah, Moran, how many of those $100 bills will I sell you at $99.20? The 112,000 revised lower. The crazy thing is the August revision. So the revision last month was oh shit, I had all the numbers. They're in here somewhere. The revision for remember last month we got 250,000 jobs. The revision was like 30 something thousand, I think. Um, if you guys know, Mike, Ron, throw it in the comments. I forgot what it is. I should have had it up here. But the huge revision, 158,000 in August, got revised to 70 something thousand. The August revision really, really threw me. So when you take the two of those, Mike says 112,000 revised lower from August and September, which we even said there was going to be. I think the September data is going to get revised again next month, and it'll be even bigger. So 250 went down to 220, and I think that'll drop down to 120. I mean, I think the revision next month is going to be crazy on this, right? So, hiring last month advanced at the slowest pace since 2020. Non-farm payrolls increased 12,000 last month, following a downward revision to the prior 2 months. The unemployment rate held at 4.1%. The BLS said the hurricanes likely affected payroll in some industries, but said it's not possible to quantify the net effect. Yeah, I don't buy it. I don't buy this. Ron said the only ones blaming this on the hurricane did not read the report. The report specifically states they could not quantify storm impact. They did state the Boeing strike accounted for 44,000 jobs, a negative 46,000 jobs lost to manufacturing. So the Boeing right now, Boeing's on strike. So all of this is just made up, though. It's so funny. Hiring increase in healthcare and government. Employment in other industries was largely flat or negative. Sectors including retail, trade, transportation, warehousing, leisure, hospitality all declined. These are all the realities of a weakening economy. Likely a reflection of weather-related disruptions. My ass. Manufacturing payroll employment fell 46,000, the biggest drop since April, largely reflecting strike activity, including 33,000 Boeing workers. And you, Ron, you said you read somewhere Boeing's 44,000. So I wouldn't necessarily see difference here. The 2%, we moved a lot more than the 10. I'm sorry, the 2-year yield, the 2-year treasury moved a lot more than the 10. The 10's at 4.26, y'all. Yesterday we ended at 4.28. Again, this jobs data didn't really, I don't regret locking into it at all. I don't think, if it had come in strong, it would have blown us apart. So, and we didn't miss anything. I mean, you're going to see a small improvement in rate sheets today, but not that much. Reprice risk on the day is moderate. 21 basis points can disappear awfully quick. Awfully quick. Mike said it is crazy how big the revisions are every month. Here you go. It'd be how would a client like it if we quarter it to 6% and the next day tell them we had to revise that rate to 7.5? I know, and it's all definitely just very, very shady. The way that all of it's done. So, but looking at the 5.5 coupon here, looking at where we're at, being up 21 basis points, barely above 99. Again, it looks great when we look at it at the 5-year though, or 5-day. I mean, this was on the 30th, 2 days ago. We were, at the same levels. We were up here at 99, 21, 23. So this basically helped wipe out yesterday's loss, bring us back a little bit to earlier in the day on Wednesday. But it didn't really do anything. So it did not turn the train. Everything is still in trouble. So we've got the election next week. It's going to be a big deal. It's not going to make an immediate effect on rates. The Fed meeting is going to make an immediate effect on rates. So next week when we get the election, it's going to take away some of the question marks, and traders will form more of an opinion of which way things are going to go based on who wins, not just the presidency, but the Senate and Congress. A lot of Senate races. So, they're looking to see if they get a red wave in there. I highly doubt they could even get a blue wave, but it hasn't even been mentioned. So, but take a look here. Nothing's changed for speculation on what's going to happen next week at the Fed meeting. Markets still believe we're going to see a quarter-point rate cut, 99.7%. It's hard to get much closer to 100% than that. This is something, though, that I noticed. The expectation of a cut down to 4.25 has improved. Remember, it was about 70%. It's up to 80%. So markets think that this sets up the Fed to go ahead and cut more in December. That's what we've seen a little bit of improvement to here. Whereas that, yesterday this was 70%. Now it's up to 80 something percent. And more than that is, here. Most don't believe it. January, a little bit more than a coin flip now. We were at almost a perfect coin flip between whether we would see more cuts heading into January between 4 and 4.25. Now 4 is the winner. So market's basically saying that they believe the Fed is going to continue to cut rates by a quarter point heading into 2025. Ron Siegel said Mester seems straightforward on a 25 basis point cut next week. Mike Thibault said comments from CNBC say one more cut next year. Yeah. They see it in January to 4, but then look at March and there's a 40% expectation that they'll keep cutting. So I don't know, Mike, if, that's CNBC, but there's so much that's going to change between now and March that we speculating, it doesn't even matter. If we continue to see inflation drop down, the PCE data, I didn't even talk about the PCE data yesterday, came in basically as expected. The 12-month rolling average is 2.1%. So that's kind of what a lot of traders are looking at, even though it's not arguably what the Fed is looking at. Ron said the jobs data did solidify a cut next week, waiting to see if Nick Timiraos concurs. Yeah, I'm sure he'll pop out with an article on Wednesday. I think all their coverage is going to be on the election Tuesday. He might pop out something on Tuesday, but we'll see. Lee, as far as cooking the books, I think the books are I think they're burnt into pieces. Forget cooking them. They're fried. They're fricasseed. They're broiled. The books are so out of whack. When you look at this labor market data, it makes no sense at all. How do we go from being up 250,000 jobs last month? Now we would have been negative without government jobs, 12,000 jobs this month. Oh, it was a hurricane. No, it wasn't. This whole thing's just nonsense. It's all broken. I don't believe any of that. So, but we will see. So anyway, as far as where this puts us, I'm still in a lock position until, we can start to float. What do you guys think? What do you think? I would say cautiously float. Let's put it. I'll switch to cautiously float today. Floating. I don't think we have to worry about the election causing any major drama. Now that we got the jobs data out of here, I think we can float into the Fed meeting, see how the Fed meeting kind of shakes things up. I like floating into the Fed meeting because it happens during the middle of the day. It's the one report that we get, the one opportunity to actually react to, rather than have it happen in the morning before pricing comes out. So I'm gonna go ahead and let me get to the comments here, and I'm gonna say lock advice. Nope, not that. Hide it. Here, I'll just cautiously, hold on, I'm getting there. Cautiously float it all for now. There you go. So my advice, cautiously float everything for now. Now that we've got this behind us, we need to see what's going to happen with that Fed meeting next week. I like to float into the Fed meeting. I don't think we have to be in a position. Taking a look here, look at this 10-year Treasury yield. After shooting up, it's definitely been there's big swings. We go from 4.25 to 4.30, but we started the day here at 4.20. Here we started the day at 4.30. We're going to get down to about 4.23 right now, probably in around 4.25. It's at 4.27. So it shows I have to refresh this because the chart isn't matching the live number. So, we're at 4.27. We're kind of capping out. And I had said before the jobs data that the technicals were in a position that we've kind of shown some more support, just like we'd gotten here. Back in early October, where after the Fed meeting, things had kind of leveled off, and then we lost ground again after that jobs data. Well, this time around, we're kind of okay. This is the jobs data there, by the way. I said early October, but what I meant was right here in September, the end of September, and then we lost ground with the jobs data. It looked like it tried to hold, lost ground again. These are bigger swings, but we are showing some support. Being that this jobs data came out the way that it is, I'll put us in a cautiously float spot for now. Chris said, what time are rates dropping by 1%? That'll be on the 9th. Yeah, they're dropping on the 9th on Saturday. So, um, Mike said it's pretty bad how much we're affected by bad reports. I agree, dude. It is. Ron said, from what I've been reading, the market has a Trump victory baked in. Yeah, they call it the Trump trade right now. If Harris wins, the market will have massive changes based on what Trump promises to what Harris promises. I don't necessarily agree that it'll hit bonds. It'll hit stocks. Stocks will get emotional and bounce all over. But the either the reality is that both of their plans are likely to push up debt. The tariffs are considered to be inflationary. I don't know that they will be, but as Ron said, I think one of two things happens: either they counteract them by actually opening plants and doing stuff to build in the U.S., or they get subsidized by the Chinese government. But I don't think they're going to drive up inflation. The consumers can't handle much more of that. Plus, when you look at what comes in from China, the items that are coming in from China, it's just I don't know. Bill said, I believe rates will improve no matter who wins the election. I agree. I think the last 2 years we've seen October kick our ass and November has helped recover. I think that we go from here to maybe back to 6.5. Right now we're at like 7.125, 7.25 here, right? So I think we get down to 6.5 in November. But we're going to need some help for sure. We're definitely going to need some help. And that Fed meeting, I think, is going to be a big part of that. So it looks like now that October is behind us, let's start November cautiously floating. We've got this jobs data behind us. Again, being up 16 basis points, not anything amazing that I wish I'd floated into the jobs data. Way, way too much risk to have floated into this one. So I'm glad that we would have locked. But now that it's behind us, I think we're all right. So that's it for me, my friends. You guys have a fantastic weekend. What are you guys doing this weekend? I am heading off. It's funny because today's the overcast and crappy looking, but we're still going to take the bike. We're heading up to West Virginia. We've got a couple cool bed and breakfasts lined up, and we will be staying at, and then we're going to a Lainey Wilson concert in West Virginia, and then I'll be home on Monday. So Ron said Musk's government cut would be bad for GDP, good for national debt, takes $2 trillion out of spending. Yeah, well, I'd like to see where he came up with that number of $2 trillion. Sounds great as a soundbite, but it's a lot harder to pull that money out than he thinks. Mallory's doing a fundraiser. Awesome. What are you raising funds for, Mallory? Megan's headed to Mobile, help some friends move into a new house and a little beach time, 80 degrees and sunny. Cool. Enjoy it. Ron, am I wearing my bell bottoms? Not to Lainey Wilson. I don't wear bell bottoms. I got my regular pants on, but she can wear bell bottoms. Tiana, barely live. You made it. Don't worry. You're here. What are you doing this weekend? So anyway, my friends, I'm going to wrap it up. Thank you guys for joining me. Again, next week, we got a little bit of a better outlook, at least. Golf course on Saturday for Lee. Bengals versus Raiders on Sunday. Hope it's a good game for you, my friend. Enjoy it. So, all right. I'll see you guys on Monday. Take care, everybody, and have a great one. Bye-bye.